tax on dividends and capital gains. How to pay no tax on dividends and capital gains. That's what we're going to talk about today. Chapter 8 of my book, The Tax Bomb in Your Retirement Accounts, How the Roth IRA Helps You Avoid It. I'm excited for this one. This one's a fun one too. Again, a lot of people don't get it. They don't get it. And this book can help them get it, which means they can reduce their taxes, maybe even allow them to live tax-free in retirement. In fact, the previous chapter I just did, and notice I still have the same shirt on, talks about how the perfect retirement plan. So let's dive right in. But before we do, don't forget to subscribe. I think it's on that side. Subscribe down below. Hit that little button to be subscribed. When you do, hit the bell. The notification bell so you can be notified for future content. And man, we do a lot of content here, and I'm excited. I just had the Freakonomics Economics podcast on behind me talking about the new tax law as well. Not so new anymore, but I mean, I'm telling you, sharing information. The information comes in this head. If it doesn't go out the other head, my head's going to explode. So subscribe down below. All right, let's dive right into this here. If I can get my screen to minimize, how do we do that? There we go. I saw it. Well, hold on just a second. Is it? You gonna let me do this or what? There we go. All right. I might stop that. All right. Well, hold on just a second. There we go. All right. I knew we could figure it out. Technology, user error, I suppose. All right. So now this is chapter 8 from my book, How to Pay No Tax on Dividends and Capital Gains, which you already talked about. If you're married filing jointly with $77,400 or less of taxable income, you are in the 12% tax bracket. Add $1 more, though, and you are in the 22% tax bracket. You see how that works? $77,400 is 12%. $77,401 is 22%. That's how marginal tax brackets work. The more income you receive, the more taxes you pay. That's the epitome of a progressive tax system. By the way, the tax on Social Security is regressive. The less income you receive, the more tax you pay. And I showed that in previous episodes where you see that you get $1 for you get $1 of income, but your tax is $1.85 of income because now your Social Security is taxed. That just ticks me off. But hey, who am I to talk? No one seems to care. All right. Other than, of course, the bewildered widows who get hit with that tax and have no idea what happened to them because no one told them and everyone's telling them to defer. And then they get hit this tax and they're like, whoa, I don't have the resources to continue to pay this. But again, hey, who am I to say? All right, but that's how marginal tax rates work. Now, the tax you paid on the previous $77,400 will still be in the 12 or 10% bracket. That doesn't change. So it's not. This is one of my issues with a thing on the Atlanta Journal-Constitution guy who said, oh, you're going to be in a 17% tax bracket. No, you're not. You're not going to be in a 17% tax bracket. The first $19,000 is taxed at 10%. The next $58,000 is taxed at 12%. Anything above that is taxed at 22%, but the effective tax rate is not even close to 17%. All right, so that's just how it works. It's just the next dollar of income you make will be taxed at the higher bracket. All right. Now, how qualified dividends and capital gains, long-term capital gains are taxed. Now, here we go. Let's say you have total income of $70,000, which consists of $60,000 of earned income from work and $10,000 in the form of qualified dividends and long-term capital gains. But you need $80,000 of income to live the lifestyle you want. So what you do is you take a $10,000 distribution from your IRA. So now we have $10,000 IRA distribution, $10,000 from dividends and capital gains, and $60,000 from your earned income. This will put you in a 22% tax bracket because $80,000 from married filing jointly is a little bit above the threshold of $77,401 to be in the 22% tax bracket. All right. So, but we are in the 22% tax bracket, even though we're only in there by $2,600. All right. Because $77,400 or below is 12%, $77,401 and above is 22%. Now, the following April, you go to your tax guy, and he gives you what you thought was to be a pleasant surprise. He says, hey, you only have to pay 15% on that $10,000 of dividends, long-term capital gain, even though you're in the 22% tax bracket. You're like, yay! I'd save 7% of taxes. That's great. I'm in a 22% tax bracket. I'm only pay 15%. Yay! And you're clapping, you're high-fiving the tax guy. Then he tells you, but you don't understand. The reason you're in the 22% tax bracket to begin with was because that IRA distribution put you there. Now you owe $3,000 in taxes because of that $10,000 IRA distribution, effectively a 30% tax bracket, a tax rate, I should say. What? How can be an effective 30% tax rate when I'm only paying 15% of qualified dividends and capital gains, and I'm only in the 22% tax bracket? Well, we talked about that in previous episodes, haven't we? If you have to pay $3,000 in taxes for a $10,000 IRA distribution, 3,000 divided into 10,000 is what? It's 30%. That's a 30% tax effective rate on that distribution. And the reason is you're going to get double taxed. I'll show you why. So next year you wise up and say, forget that. I'm going to make $60,000 of income. I still have my $10,000 of qualified dividends and long-term capital gains. But instead of taking a $10,000 distribution from my Roth, I am taking a $10,000 from a traditional. I'm taking a $10,000 distribution from my Roth IRA instead. Now, when you go back to your tax guy, you do get a pleasant surprise. He goes, hey, you don't have to pay that $3,000 again in taxes this year. And you're like, whoa. How can this be? I still have the same amount of spending money. And he explains, your IRA distribution last year not only increased your marginal tax rate to 22%, but it made your qualified dividends and long-term capital gains taxable as well. Because when you're in the 10 or 12% tax brackets, you pay no tax on qualified dividends or capital gains. That $10,000 IRA costs you $1,500 in income tax, and it costs you $1,500 in taxes on your dividends and capital gains. A double whammy if ever there was one. But because your Roth IRA distribution is tax-free, you remain in the 12% bracket, and taxpayers who are in the 10 to 12% bracket do not pay tax on those qualified dividends and long-term capital gains. So you don't pay tax on investment income or that distribution either. So essentially, the Roth IRA saved you from income tax on your traditional IRA, all right, like you had to pay the previous year, but it also saved you from having to pay taxes on dividends and capital gains. Isn't it beautiful? Taxpayers in the 10 to 12% pay zero on qualified dividends or long-term capital gain. And here's the problem. Many people believe they're saving on taxes with their IRA because they get to defer the tax until later. And this is true for some taxpayers, especially those in the higher bracket. Deferring a high tax now to only have to pay a low tax in the future does make sense if that is going to be the case. And frankly, I don't think it's the case nearly as much as what people do. But what about taxpayers in the 10, 12, and 22% bracket? Are they actually saving taxes by deferring it? No, I don't think so. Maybe a few, but the vast majority are not. Some analysis would, of course, need to be made, absolutely, to your specific situation. But please don't fall for the legacy or the fallacy that deferring taxes is all-encompassing, a benefit to everybody. It just isn't the case, as I just showed you. Please remember, you want to reduce your ordinary income tax investments. Ordinary income is bonds and traditional IRA distributions. Those come out as ordinary income. Interest on bonds, interest on CDs, and IRA distributions are OI. That's the worst kind of income tax you can pay. And you want to increase your tax favorable investments like Roth IRAs, qualified dividends, long-term capital gains. Some would argue life insurance loans, it makes me a little bit nervous there. But Roth IRAs, qualified dividends, long-term capital gains are absolutely tax favorable. And of course, Social Security. Can't forget Social Security. That's absolutely tax favorable. We want to increase those Roth, Social Security, long-term capital gain, qualified dividends, decrease your traditional IRAs and your income from bonds and CDs. If we can do that, that is a wonderful place to be from a tax perspective. If you like what you see, subscribe. Thumbs up, my friends. I'm telling you, YouTube, the algorithms, they love the thumbs up. So give me a thumbs up if you would. Comments are always welcome. Comments certainly welcome. Go to heritagewealthplanning.com. heritagewealthplanning.com. You'll get the pop-up for the book. You'll get the free PDF if you fill out your information for the pop-up on the book. Absolutely do that for sure. If you go to Amazon.com, like I said, it's free until August 20th, and this is 2018. After that, the Kindle version is only $4.49, my friends. This chapter right there probably saved you $4.49 in taxes alone. $4.49. Kindle Unlimited is tax-free. It is free. It doesn't cost anything for Kindle Unlimited. I'm working on an audiobook. I should have that done here in the next couple of days. So see you next time on Heritage Wealth Planning YouTube channel. Thanks, guys.